Welcome to the video portion of the Grain Navigator. I've taken the PDFs and put them on to a PowerPoint presentation and now converted it to a video so you can watch it at your own leisure. So Grain Navigator, what is it? And why would you invest your time watching this video? The whole point of the Grain Navigator is for you to gather knowledge about the markets. And at the end of the day, you want to make some money with the information you gleaned. It's as simple as that. So what is this Grain Navigator publication? Well, over the years, I've determined that we really are drowning in a sea of information, yet we're starving for wisdom. There's so much stuff coming at all of us every single day. Farmers are getting many text messages, many emails, all the time. And what do you do with this information? Unfortunately, most of it is just fleeting. It means nothing tomorrow. So what the point of this is, it's a long format grain marketing educational platform. It's designed to remove the market chaff and chatter. It's designed to give grain farmers a marketing edge by examining and explaining the market forces that influence grain prices. It's not regurgitation. We're just not out there regurgitating Google alerts or anything like that. This is big picture thinking, putting the pieces together in multiple media formats. It's taking the time to figure out what all of this actually means for the Canadian grain farmer. It's quite a bit different here than it is in the States. So what does that report mean to you? So we started the Grain Navigator off with an executive summary. The World Ag Stage. What is going on in the World Ag Stage? Well, March is everything to do with all things production in North America. April 1st, the first crop reports come off, and everybody all gets worked up about them. It's just the way it goes. And right now the market is set up to be very explosive during this year's growing season. In the financial world, everybody is printing money, and quite frankly, they're out of control, and something is going to have to give at some point. Money will always flow to the point of greatest return, so that's pretty obvious. And we're going to have extreme price volatility, and we're seeing that this year already with our commodity prices. So the risk-reward management going forward here, what can you do as a farmer? The number one thing we can do right now is recognize this velocity and volatility. You see, volatility is how high these markets can go and how much they can swing. Velocity is how fast it can actually move. When money moves from one asset to another asset, it can move extremely fast in today's world. We can move $1 trillion in a matter of seconds, really. Things have suddenly gotten real. So we got to stop horsing around with looking for these 10-cent gains and stuff like that when things are actually moving $1 or more either direction. These market moves can definitely cost a farm hundreds of thousands of dollars if you're not prepared. Just think about it, if you're a 3,000-acre farmer, you probably have at least 200,000 bushels of grain. This year we saw that where guys were potential gains could have been well over $200,000, if not more. It's time to understand your profitability and capitalize on the knowns. What do we know about the market right now? And this is what the Grain Navigator is trying to accomplish. And it's all about hedging your bets. We don't know what's coming down the pipes in 3 months with the weather or the political policies. But how do you hedge your bets so you can come out ahead year after year? So this is the first thing we want to talk about is the weather. The weather is very important, of course, as farmers. We're setting ourselves up for a La Nina year, as you can see. I'll just do the chart here. We are entering into a moderate to strong La Nina. And what does that mean? We saw the same thing in 2010, 2012, 2011, and 12. So those years, following those years, were high price years. You'll see some charts on that later. But it's important to recognize what the La Nina setup will do to the farm and the production. So we're just going to explain that next time. So La Nina precipitation. This is really important for us, obviously, as producers. You know, look at the Midwest here. Look at the states. You know, October to April it's dry, so and then May to September, right in here where they grow the corn and all that fun stuff and wheat, it could be really dry. But one thing we really want to look at here as Canadian grain farmers is September to February and September to December. This whole area here where we are, where we grow our crops, it's calling for a wet, it looks like a wet harvest season, a wet fall. So we want to be concerned about that, see what that actually does. This is about hedging your bets. What kind of crops can we grow if the setup is already there for a potential harvest that could be hard, right? Like we saw last year. We don't want to see a repeat of that. Obviously, nobody does. That was not fun. And, you know, everybody got kind of sick of the old reverse feeder house, right? So that was not a real fun time for anybody. Anyways, so that's what potential could happen with the weather. Now let's look at canola here. Canola is obviously right in the forefront of everybody's mind right now. It is absolutely crazy. I don't believe anybody actually thought it would go this high into whole new territory. It did look like it was a bullish scenario this fall, but not to this extreme. And that's what we're talking about with this extreme volatility. When we get this much money hitting the system, the market can easily do that. So with the canola, the world production is down, and ending stocks are also supposed to decrease this year. And that's very important, the ending stocks, right? In 2019, the world ending stocks peaked out at 9.6 million metric tons. So that's basically half of Canada's crop. In 2021, they're expected to only be 5.1 million metric tons. And that's around the whole world. So that's the ending stocks, how much we have left over at the end of the year has dropped by half. Now that's a significant drop, right? So what it's going to take a significant production increase worldwide to increase the 2022 ending stocks, where the market is actually comfortable. Once the market is comfortable, it doesn't have the same extremes in the volatility, right? Because it's a stable market. There's lots of a buffer built in, right? Now this will probably be extremely difficult because in 2018, the EU banned neonicotinoids, which is basically the seed treatments. And this is why pre-2018, the EU production was over 20 million metric tons. And since then, it's dropped to 16 million metric tons. And that's a deficit on the world scale of things. And apparently, it was actually getting pretty bad out there where they just couldn't get the canola to grow or any of those brassicas apparently because the flea beetles got so bad. That's what I read. So anyways, if we've lost, 4 million metric tons, that's like basically, well, say it's like a quarter of the Canadian canola crop. It's a big deficit. And so this deficit must be made up by other countries because Canada's pretty much maxed out on how much canola we can grow, right? We seem to have a hard time getting above this 20 million metric tons. And especially this year when there's all these other profitable crops out there too. So what's going to happen with that? And apart from just canola, the overall global oilseed complex is extremely tight. There is no room for error on the oilseed complex this year. So basically, what I'm saying here is 2021 had better be a bumper crop, or these current high prices that we're seeing right now, they're here to stay. So, I mean, the new crop is at a significant discount, but the old crop, perhaps the new crop will start to rally up to that price, those price points, if we have any growing season problems, right? We'll talk about that in a bit. So we want to look at the market zoning and timing. Pre this year, it was a pretty safe bet to say that 440 was the floor on canola, and that's because we've hit a super cycle in 2008. And that's basically $10 minus some basis, so you're looking around $9.50, depending on where you are, right? But that was a real low in the markets, and that's why we saw last year and a couple of years ago when the market had a hard time breaking above 10. but it really didn't fall much below those mid 9s, which was with the basis and everything. So if you look at the chart there, it will explain that. But now I think those days are over, because I think the market has fundamentally shifted into a whole new price zone. I don't think it's a price, it's a commodity super cycle shift where it shifts of that golden ratio up to 1.6. So that would mean our new plateau would run around like $700. I don't think we're doing that. What I think we're doing is we're hitting a new plateau within the current price cycle, right? And that price cycle, I believe, is from 440 all the way up to, I believe, about 650, a little bit higher than that right now, 700 or so. That's where that zone is, right? So until the fundamentals change, we think the new price range is probably going to be between that 550 to 650 on the futures. This is assuming, of course, we have no production in the next 2 years, because it's going to take that long to even get our stocks rebuilt. So if we have any problems, this thing's going way higher, and I don't think we're going to have a massive crop across the world on the canola to push it way down back into that $10 range. That could be happening in a couple of years, but this 2021 crop is probably not going to come crashing right back down. So, but obviously it's all production related at this point. And there's also these few other things happening in the world scale things. So it's very important to remember we probably haven't hit a new super cycle. So that means we're probably not going to bounce around at $800 like we're seeing right now. So, and if you understand how the charts work, that's very critical. Smart contracting. I mean, 2020, what do we do with the crop we have left? I don't think many farmers have much crop left. There is a small possibility it could run over $1,000. I believe the actual number was around that 1,040. But most likely, as we continue on, it's probably going to drop down to that 650 as sales come off and we get closer and closer to new crop. But then again, it's all weather related. And at this particular point in time, most farmers are sold out. You're just in a canola casino right now. And why not see how high it goes? Because in the summer, it could really take off. That is the reality. So in 2021, we don't know anything about growing seasons. We want to look for opportunities to lock in profitability, of course, right? And since the case can be built that the range of canola over the next year or so, maybe 2, depending on production, of course, will be that 550 to 650 range, it would be wise to capitalize on these upper ranges. So when we see the new crop prices rally up to that 650 range, it would be wise and prudent just to sell some percentage, right? Remember, there's nothing wrong with locking in 25% of your canola production. And if you're making like $250 an acre, pure profit margin, that's a pretty good return on your investment. So nothing wrong with that. Consider that and just make some money on it, right? So our current trends and looking forward, what's going on right now and looking forward. So like I said before, and I alluded to in this whole presentation, is the market is really set up for some serious excitement during this growing season. We have some financial worlds, we have extreme demand and also supply, and that's not just with oil seeds, that's with everything right now. We know that. So that's the setup. Any thought of a drought or any slight hiccup of anything this year is going to drive this market crazy. And that's something we just got to pay attention to, right? I mean, it's a pretty safe bet to leave some production on price this year. Even though I said previously, why not lock in 650? I mean, that's just locking in pure profit. But it's a pretty safe bet to say that this thing probably isn't coming crashing down. However, it does go without saying that China and our other trading partners need to be watched very carefully. We don't know what's going on in those places, right? And remember, it only takes one idiot in Ottawa to say something stupid, and the whole thing comes off the rails. We've seen that before. We've also seen silly phytosanitary restrictions come on. I mean, there was also that earthquake in Japan about 5 years ago, and that wrecked the whole market for quite a while. So we got to be careful of all this stuff, and that's why I'm a big believer in grabbing profit when it's there, right? So moving forward, the best thing a person can do right now is take some money off the table if you haven't already done so. And obviously it depends on your risk profile, but like I said, there's nothing wrong with taking a profit. It's also very important to realize the reality of this thing is that the S&D is extremely tight, and any issues with production could cause the market to literally jump like $200 overnight. So if like old crop is around 800 right now, new crop is around 6, I think when I looked last, 610, that could easily jump up to that old crop price levels if there's a production problem, right? That's not to say it's going to. There's going to be a million other factors in place, but the reality is it can do it, right? Especially this year, you don't want to get caught by overbooking because everything in this environment is expensive. A screw up is super expensive, regardless if it's a contract screw up, a hedging screw up. So you got to really remember that. And we're seeing it right now with people trying to buy out contracts on canola that's heated. It's very expensive. You want to take a look at some different insurance programs. This year there is a year where maybe some big premiums have some big rewards. I don't know what the insurance or price insurance premiums are right now, but that could be a good opportunity. You might want to explore different futures and option strategies depending on your risk profile and who you have working for you on that schedule, right? So that's just some things we want to look forward to going forward. One thing here is we want to look at kind of some general selling thoughts here. I've kind of put this chart together. Hopefully it helps you guys navigate through the process of marketing, right? So spring, summer 2020, I guess that's actually 2021. We should be 100% sold at 18. I mean, that's after this, we're just gambling, folks. But you might, why not keep a load back for speculation? See if you get that $20. I have no idea at this particular point in time. So the 2021 growing season, that's this season coming up right now. So we had the fall of 2020 and the winter and spring of 2021. 10 to 20%, $12 to $14, depending on who you are and your price levels, where you started pricing. Nothing wrong with those kind of prices, right? And for summer 2021, let's see what happens. Like, this could be really exciting, and you definitely want to have a bit of room in your booking profile that you can actually take advantage of if there's any summer rallies. Because remember in 2011 when the wheat rallied up to $9 for about 2 weeks, that was exciting times, right? So we're just going to assume normal growing season and average production, and the trend for the next 90 days I think is a very stable trend at these high prices. I mean, we just don't know what's going to happen, but it's probably going to stay high because we know we're going to run out of canola. We have a very unique situation right here. Long term, like say the 6 months, this is extremely S&D dependent, much more than we've seen in other years because of the tightness of the stocks, right, and a lot of other factors. The lower range that I think is going to be happening in 2021 is we're going to see some major support around that 500. And if there's a bumper crop, I think the market would be pushed down that far, and maybe a guy wants to sell half your production at that. I mean, that's not exciting at all, but it's a lot better than what we sold before. The most likely range this year, and I mean, I got a thing here that says S&D dependent, because that's so real, is between a 550 and a 650, of course on the futures, right? And this is all metric tons. And so that's getting close to that 12 to 1450 to 1460 dollars per bushel, right? So that's something we want to consider. If we get to those prices, say we got to, once the crop got harvested, we kind of knew what was going on and it was still in that 650 range, maybe you guys want to sell quite a bit. The ultimate high range, I mean, this is if we got production problems, maybe it's $700 to $800. That's like the current prices we see right now. And at that point, maybe you just want to sell out and keep some back for speculation, right? So canola is an interesting thing. We're going to look at this 20-year chart on canola, and this is where we're getting some of this information. Let's just, whoops. So you can see here this line here where it says 0. This is our old super cycle. Anything pre-2008, the highs were the 440. and that becomes the new lows basically. That's why I can say confidently that 440 is pretty much a new low. When we see this, we can go back a couple hundred years, if not further, on different commodities, and we see this in every single commodity super cycle. Old highs become the new lows. It doesn't matter what the product is, right? Anyways, this is what I think where our range where we were for the longest time was in this range here, as we can see. We hit that 550, but I think this time on this range here, ooh, is 545, so 550, and I think this one here is at 650. So I think those are reasonable ranges to say this is where our crop probably will end up next year. Obviously, we don't know what's going to happen. I don't think we're going to bounce, stay in these high lofty levels up here, or even here in 2008. Now that was 2008 was a true commodity super cycle. We saw that with every single commodity out there, and then there was a bit of a problem post 2008, right? So anyways, we want to be concerned about that and understand why these markets go the way they do and how they behave, because there is some behavioral things with charts. So anyways, that's the canola. We're going to move on to wheat now. So the world stage of wheat is basically the world is always increasing wheat. It has increased year over year for the last 10 years. It's actually quite amazing, really, when you think about it. Basically, wheat can be growing all over the world, and everybody's doing it. And we've all gotten better at growing wheat. So that's something to consider, is why we're growing wheat when everyone else can grow wheat. Now, profitability may start to come into play with this thing, in the profitability ratios, I mean. So in the last 20 years, and this is a ratio, the ratio between corn and wheat has been about 1.5, meaning wheat is worth about 1.5 times more than corn. Now, currently, the wheat and corn ratio are basically the same. And the last time I checked here it was around 1.07, right around there. So what that really means is that if you're a farmer, you're going to want to grow. There's no incentive to grow the wheat because it's cheaper, right? Relative to corn. So you're going to have to pick that and not grow as much wheat, and wheat will probably suffer an acreage loss. This is basically what we're saying here. So on the world stage of wheat, one of the most important numbers in all this data is the ratio from ending stocks over production. If the ratio is getting larger, it means that production is outstripping the demand and the ending stocks are growing. And when the ending stocks are growing, it just simply means that the supply is growing and there's a lot of stuff that's kicking around, right? And nobody is even cared about when we have an excess of wheat kicking around. Of the last 10 years, the previous 3 have been the highest at 39%. That means that we have 39 of the how much we have left over is 39% left at the end of the year of what we produce. That's a lot of wheat. We're really not dropping our ending stocks. And this is exactly why wheat prices have basically remained real flat for the last 3 years, because supply is ample. Now, if you take a look at 2011 to 2014, this ratio was running below 30%. And if you look at the price was significantly higher. And that was also a La Nina years, right? In 2010, I believe, to 2012, I think those were La Nina years if we look at the last chart. And the prices was obviously higher. So when that happened, the Kansas wheat futures was closer to $8 a bushel. And that's a stark contrast from 2017 onwards, where it's only down to 4. Now, this ratio obviously has a very important marketing factor for understanding what's going on and why it would change. And so that's what you're really concerned about, is would this ratio change? If it gets smaller, the wheat price is going up. If it gets bigger, the wheat price is going down relative to everything else, right? So we need to examine, there's a chart coming down below here, needs to be addressed, and that is China. And the question is why since 2018 has China been increasing their ending stocks to the degree that they have, 1, year supply on hand. China is doing this with other commodities, so what does it really mean? Now let's just take a look at this chart here. So I'm gonna So you look at China here. In 2018, 106%, 114%, 112%. That means they have more ending stocks than they actually produce. Why are they doing this? That's a good question. And they're actually doing it with all the other commodities also. I mean, Canada, we were looking at 12%, 17%. And the world has been stuck here at 39% for the last 3 years. Where if we look at these other years, 29% in 2011, 28% in 2012, those are higher price years. So that's very important to remember that and understand what is actually going on. So the thing with China, we don't obviously know all the information that they're giving us. Some of it could be corrupted. But, you know, there's some truth to some of this data. If they truly are really increasing their ending stocks, what does that mean? And how long will they continue to aggressively buy commodities? Once they have their ending stocks bought up that they need, they may just pull away. Now that's a very important number to remember, or fact anyways. So will they ever pull away from this market? So let's talk about some market zoning and timing. Long story short, a bumper wheat crop is good for nothing. There needs to be a drop in the ending stocks for the price to really drop. I think it's around that 34%, and then the prices will start to come back right up. 2021 wheat production is very critical. Now, if history repeats itself and the La Nina develops, which should cause wheat production to drop significantly, then we can expect a big price rally, especially since all the other commodities have rallied up so much. Money will flow into wheat because there's a perceived problem, and it could shoot up really fast, really quickly, right? So I really think that 2021 wheat production is really critical, and the weather is really critical. Well, that's obviously goes without saying, but I think it's more critical this year than other years. So we'll just look at this little chart here. As you can see, the 20-year Kansas wheat chart. And obviously in 2011 to 2011, 2012, high wheat prices. Then obviously our production gets better. You can see 2017 and onwards, high production, high ending stocks to production ratio. Prices are not doing any good at all. And now all of a sudden things are getting dragged along. And I've been saying wheat is going to get dragged along in this market, whether it likes to or not. And quite frankly, I do not think wheat really likes this high price because I don't think it's justified. But all we need is a bit of a production issue, and we're right back up there. When we look at compare it to soybeans and corn, we could be up in this range here pretty quick. So risk-reward management, any wheat that needs to move before summer, we should probably be pricing at these levels. I know some of the local elevators here, their prices are significantly better than they were even in January. You know, some of those guys are at least 50 cents a bushel. So, I mean, it's good marketing. It's good pricing. It's quite a bit better than last year. Throw some targets in if you don't like the price. I mean, they are coming to the market for good quality grain. And again, summer could get really exciting. Like I said, any trigger event could cause this wheat to jump straight up there. Be ready for it. This is simple as that, right? And wheat was going to have to get back into line with soybeans and markets. The market always will always do this. It will always realign itself and come into equilibrium. We just don't know when, and we don't know exactly where this equilibrium is, but we can have a feeling on where it is, right? And we're not in equilibrium at all. So wheat has to go up, or soybeans and corn have to come way back down again. That's kind of basic economics, right? In 2021, there have been some really good pricing opportunities on that CPS wheat, especially on some of these futures only contracts. That was way back in December, January. But at those kind of prices, it was awesome. With hard red wheat, I don't really see any opportunities right now as far as pricing. I mean, there's a lot of horseplay that goes on with, grades and falling numbers. I mean, we saw that in 2019 and other phytosanitary regulations, we'll call it. So let's just think about that with the hard red, mainly because we saw in that La Nina year, the fall could be a harder harvest, and nobody likes to book a number 1 or number 2 hard red, or and end up with a low falling number and have it all rejected as feed. That's not really a good scenario. So what we do know about 2021 coming forward, we know last year was a record wheat production, and it just keeps getting bigger. Ending stocks are extremely high, so that's a known. That is a negative on wheat. La Nina is forming. If that's true, and it does what it did previously, that's a very positive for wheat, right? China has been stockpiling. How long is this going to last? This could be positive or negative. We don't know. They could go way higher, or they could just say, okay, we've got a year's supply, we're done. And they don't buy and they just maintain it, right? So previously they were not maintaining, they were building. So if they go to maintaining mode, it changes. And other people are doing the same thing. I think it has something to do with a lot of speculation. I think world's a little bit more concerned now, especially with this COVID and the supply chain breakdown a little bit, right? And you got to remember, wheat is undervalued compared to corn. This always corrects. We just don't know when. And remember, the market can always remain irrational longer than you can remain liquid, right? So it could be like this for another year, maybe 2. Who knows? But it will correct. But in the meantime, you have to pay your bills, right? So that's just something we got to think about. Smart contracting, targets. You just throw some targets in. Throw them in what you want. I mean, elevators, if you've got good quality, elevators are pretty aggressive for good quality right now. 2021, CPS, if you're growing that, there's some really good opportunities above 7, and just book some safe percentage. I mean, you're making really good money at $7 CPS, especially on the yield on that stuff, right? And obviously, we all understand how CPS grows, right? And hard red is probably best to take a wait and see approach, right? And the opportunity isn't that much when you consider the potential grade risk, right? Obviously, that depends on where you are and stuff like that. But out here in Alberta, it's a bigger grade risk we have, right? So why not throw some lofty targets in? Because if we have any problems growing this thing, take a summer rally. But you got to be quick. You got to have those targets in place, the ones you want. I mean, you can't go crazy and stick, I want $15 wheat. That's not going to happen. But, $9 wheat. What happens if we get there? It could happen. So we just have to wait and see on that, and see what the weather brings, right? Moving forward, the best thing you can do right now is be prepared for this La Nina event. I know maybe I sound like a broken record talking about La Nina. But again, if there's any weather problems, we've got to be prepared for them, right? The market probably isn't coming crashing back down to like that $7 stuff where wheat was, hard to sell, right? It's probably not going to do that. Placing your bets, you probably got a better bet of waiting her out and seeing if it comes up another 20 cents or so, right? So let's get prepared for that. Understand the prices you want. We know that the setup is in place. It may not work the way we want it to, but it's set up. So we need a trigger event to cause this to happen, right? So why not just decide on how much you're willing to price and at what price, your percentages, and throw some targets in at the elevator. They'll help you out there, no problem. They're great people. And just see what happens with that. But you got to be prepared for when this market goes, because this is a setup where it could shoot up 50 cents to $1 a bushel in a week and then be gone. We saw that in 2011. So something just to remember. So here's the general thoughts again. 2020 harvest, we're not even going to talk about that anymore. I mean, this year should have been 2021 on the spring harvest. The last year stuff, well, you could sell $8.50 if you're getting it. I know there's some guys getting that right now. $8.50 on that wheat, on that hard red, right? So why not sell some, right? 2021 growing crop. We did some CPS futures only. There were some good opportunities in that. Maybe have some room for some summer rallies, right? See what happens, right? But we haven't harvested yet, so we don't know what's coming down the pipes. So we're assuming it's a normal growing season with average production. I mean, obviously, if there's this weather event, La Nina, prices are coming up. I think the lower range is around that $4. I mean, a bumper crop could push it down even further, right? This is obviously on the Kansas wheat futures, right? So it would be higher here in Canada, right? Because that's the U.S. And then you got to add a Canadian basis, which is positive most of the time. The likely range, I think, is going to be a slow upwards. That 5 to that 650. I think we saw on that chart it had a potential to hit up there. Just on if we have a normal growing season where things are a little bit tighter stocks, just because guys aren't growing as much, right? So 650. This is on the futures, of course. Remember that. What does that translate into Canada? At $1, maybe $2, probably closer to $2 on your basis, right? And see what happens, right? And that's obviously, this is US dollars, right? So, and if a breakout range is like 750 to 950, I don't know what that works into Canadian dollars because our basis and everything, but it could be, I guess it would be between $11, $12 wheat, which would be crazy, right? So it's got potential, but this is kind of a, shot at the dark here, shot in the dark. And this one here is most likely. So let's move on to barley here. We'll talk about that. Again, we have the world stage. I mean, this is a really interesting thing, barley. We've never seen this before in Canada. It's actually really exciting what's going on with it. What do we do? For the first, excuse me, cannabis, for the first time, Canada really needs to look at the world barley situation, right? It wasn't too long ago when barley was in wheat board purgatory, and it was basically a feedstock, and nobody even cared about barley, right? And a lot of farmers viewed it as a necessary evil. I mean, obviously it depends where you were, but it was a rotational crop. That's changed since all these elevators have moved in. We've got G3s moved in, Pattersons, P&Hs, Cargills, JRIs. They're all getting pretty aggressive on this, and they have an export program. So that's why we've all of a sudden got to consider this world barley scenario, right? And that surge in elevator capacity has given barley a whole new life, right? It's all of a sudden become a mainstream use, and the barley market or the exports is not going away anytime soon. It's in the elevator's best interest to move product. That's all they care about, is turning inventory, right? And if they can do that with barley, they're going to do it with barley. So I think that program is here to stay, and that's really good for the Canadian farmer. The world barley production, we'll take a quick look at this one here. As you can see, I think this was 2021, or last year, sorry. Australia was at 13 million metric tons, right? Canada, 10.7. But look at it, Russia's at 20 and Ukraine's at 8. This is a big game, Russia and Ukraine, because if China decides to build their Silk Road Railway, or they are building it, sorry, they could buy it all from Ukraine and Russia, no problem. That puts Canada at a disadvantage. That's something we want to always consider. And the EU, they're just huge producers, obviously, right? So let's just take a look at that. The United States, they produce hardly anything on the world scale things, but they're corn producers, right? So barley world ending stocks, we got to kind of look at this now all of a sudden. Obviously, it's been dropping. It's been going down, down, and down, probably because there hasn't been a lot of money in barley compared to the other crops. And this is what we're seeing. The cure to low prices is low prices, right? So all of a sudden our supply drops enough where they needed to buy it. And then obviously there's a bit of a spat with China and Australia there, right? So that's helping us, not helping them, right? So market zoning and timing. So why did barley rally up so much? I think I kind of built the case before. Like, we've got a whole new demand, right? And obviously supply this year was not super great. It wasn't a disaster, but it wasn't great. It was definitely below our trend lines, right? And so is there a justification for this new price plateau that we're seeing? I personally think there is, and that's mainly because of this elevator program we have on. It is until we increase our barley production enough that it can drop and the price can drop, right? So because we've got this brand new S&D equation in Canadian barley, it probably has hit a whole new price level plateau. In the new demand price, in theory, I think is going to run between $4.75 to $6, depending on the situation where you are, right? I don't think we're going to see this current like $6.50, if not higher, right now, but we could. Traditional FOB barley spreads. Now, this is something we really want to consider. It's changed. Elevators operate on rail freight, which is much cheaper than truck freight. So we got to ask ourselves this question. Is price still a function of Lethbridge, or is price now a function of port? That's a very important question because it's going to change. It will change your whole pricing strategy once we understand it. I think it's a little bit new to figure out how it's all going to play out yet, but I think we're moving to more of a port type thing because the elevators are going to set the stage. Risk reward management. 2020, if you've got barley left, sell it today. Like, this is crazy. Actually, the feedlots are getting a little bit filled up for, March. Obviously, we're almost done March, April, and even May. I mean, there's only June and July real left before we get new crop barley on. So there's not that many days left we have to worry about it. The elevator bids are dropping, of course. And now it's barbecue season coming up, so the feedlots just aren't going to be as full as they could be, right? The bulls are watered and fed in this market, right? They're happy. The market has been stable for the last month, I guess, maybe even longer, right? At 2021, there should be a significant portion of your barley sold to the elevator already. They were super aggressive, and any price on barley at $5 is basically a no-brainer. I mean, we saw as high as $6 for a little bit, right? We know this. We know there is a lot of barley growing this year. Every single farmer that I've talked to is growing an extra quarter of barley. That adds up real fast. It could be as high as 13 million metric tons. I don't know if it's going to be that high, but it could easily be that high. New crop sales have been super aggressive at the elevators, and that's all the export programs. And the export program last year was like 3 million metric tons, just over that. Next year, maybe it could be 4. I don't know. But the moral of the story is it is super strong. We've gone from like under 2, and then we're going to be probably doubling it in the next couple of years for sure. Canada's ending stocks, like, we're going to have nothing left. Like, it's all fumes. And then we've got this trade dispute with China. We're not quite sure how it all plays out, but we know once it does, it's very advantageous for China to buy their barley just from Australia. And so that's a real potential negative to Canadian barley prices. And so that's why I would recommend being highly aggressively sold on barley at the elevator. And we also know that there's a tight corn S&Ds. So if you've got barley left, just give me a call. We can sort that out, solve that problem, no problem. But, a 2021 crop, this is one time where you're like, there's probably nothing wrong with selling 40% of your barley crop, because the prices are that much higher than standard prices. If you really haven't sold anything, you got to get some sales on the books, right? And so the current trend and looking ahead, under normal circumstances, the probability of new crop barley being lower in the fall than it is right now in the fall is pretty high. The amount of barley that will be grown is very large, and export demand is only so much. Now, I don't know how much export demand is on there already. I have some inklings, and it's very high. But it depends how much we grow. If we have only added 1 million metric tons of new barley into the system, but we sold 2 million, it's going to go up, right? Or vice versa, it's going to go down. Expect the S&D to come into alignment on this, right? So again, the barley. Again, if you've got stuff left, there's nothing wrong with selling it at this 650 range if you can get that, and that's an FOB price, right? I know there's people paying it. You know, and then for your new crop, 10 to 50%, between $5 and $6. That's good money in your jeans, right? Most guys have never seen barley at $6, right? So, and then again, have some room to take advantage of a summer rally, right? Again, we're going to assume we have some normal growing season and average production. I think the price is going to be relatively stable going forward. And I think long term, I think this thing is down, even on the S&D, right? I think our major support this year is going to be around that 450. And bumper crop probably would push it down a little bit more. But most likely, I think it's going to be a slow downtrend, 475 to $6. You know, if you got a 575 off the combine, why not sell 65% of that? I mean, that's easy money. It's and maybe wait on canola or something like that to speculate on, right? So if there's a high range breakout, I'm going to say around 650. I don't know if it's going to get much higher than that, but at that kind of price level, why not sell the majority of your crop, right? That's just such good money. So the action plan here, kind of talked about the 3 different major commodities that we grow out in this area, is this summer is set up for some really volatile markets. We know that. It's coming down the pipes. There could be large price swings in either direction. The magnitude of money that has been printed in the whole world is conducive to massive amounts of swings, right? And we also have the weather pattern, La Nina setting up, and of course we always have politics, right? I mean, who knows how that goes? So that's something we always got to watch, and when there's money on the table, we got to pull it off. So, you know, a few suggestions in moving forward is be ready for market volatility. Have your pricing targets in place. Know what you want and throw them in and know the percentages you want, right? You don't want to get oversold in this kind of market. If you don't get the production, the risk is huge. It really is. And you don't want to be the person writing the check for $50,000. We're seeing that right now with canola. And that, I'm sure that's not a fun day, right? So, and just write your strategy down. Just take a little notepad and say, I'm going to sell this amount at this price, this amount at this price, and go forward. Have a backup plan for sure in this market, especially because it's so volatile. What happens if your crop fails? What are you going to do? Who are you going to call? Right? You have insurance. You have you have a futures broker, or you have this or that. What are you going to do if the market never rallies and you did no price and you saw the opportunity now and you did nothing? It just keeps falling. We could see that. That happened in 2008 and it didn't get better. We saw that when that earthquake happened in Japan. We lost, I think it was about 10 months of marketing because of that, because there was uncertainty. It just crashed everything. So what are we going to do in that scenario? We have to be prepared for these unlikely events that do happen all the time. So hopefully that helps. Hopefully you got something out of the video here. So if you're looking to purchase this grain, the Grain Navigator, for more of a continuous updates and marketing plans, you know, it's designed to make farmers more money. The information gleaned from this publication, I'm sure, is worth tens, if not hundreds of thousands of dollars to most farmers if you're of any consequential size. We do it once a month. And of course, it's going to include important updates. And right now, I think it's a steal of a deal. I'm only charging $75 a month. You just go to insideag.com and follow the Grain Navigator links, and it'll take you right to how to purchase it, right? So you want to do that. And you know, what if some of these ideas net the farm 100 grand? Would that help? I'm sure most farmers would. So here's some of the services that I do provide for guys. We do have our Market Max program, and that's a high engagement partnership. It basically includes everything. That's something there. You have to click the link and you have to fill out a form because it's pretty intense. The Market Defender, that's a low engagement partnership. That's also important for most farmers. Grain Navigator, we just talked about that in grain sales. If you have grain that you need to sell, just give me a call. I'll help you put the trade together and we'll figure something out, right? So dollar for dollar, it's the best bet investment your farm will ever see. So I really hope you got something out of this video, and I hope you learned something. But thanks a lot, and have yourself a great day.